Hello, everyone. Thank you very much for joining me today. My name is Corey Daharsh. I'm with Advanta IRA, and our topic for today's educational webinar is just the basics of fair market valuations, also known as FMVs. Again, my name's Corey Daharsh. I'll be presenting today. I've been with Advanta IRA since 2016. I served a number of years both working in the back office processing transactions and the accounting side of things, as well as serving as a client account manager for most of my time with the company. So I've got a lot of experience in handling different transactions, seeing how clients approach different investments, and specific with fair market valuations, I've processed so many of them that I'm pretty well versed in what you're going to want to provide, what type of details we're looking for. And that's really why I'm trying to bring this content today, because it's a topic that everyone has to deal with once a year, and it really helps when we make it as smooth and simple as possible for our clients. I want to share that everyone will be muted for the duration of today's presentation, but I do want to encourage your participation. So if you can use the questions box in your GoToWebinar panel, I will check on that and go ahead and answer things as I'm going if they relate to the presentation. But I don't believe we're going to take up a full hour with today's content, so we will have time at the end for a full Q&A session with the questions panel. One other item is that I've also uploaded a PDF copy of today's presentation in the handouts section. So if you're interested in actually downloading and reviewing today's slides, you can do that through handouts or by emailing me separate after the presentation. So just a little bit about Advanta IRA and self-directed investing in itself before we jump in hyper-focus with the fair market value topics. We as a company have been around for 21 years in the self-directed investing space. We've got just under $3 billion in assets under management held by our clients. And all of our clients are paired with a dedicated client account manager that actually is your go-to person. Again, I served in that role for about 5 years, but you'll have a go-to person that's there to help you with anything you need with your account. All of our clients' funds are also insured up to FDIC limits through various financial institutions. So when you have money that you don't have in an active deal, that money is safe and secured. It's sitting with us in a non-interest bearing trust account, just waiting for your direction to, again, self-direct the dollars into deals that you found. Just a quick disclaimer, I'm here to provide educational content. I'm not a tax professional, legal professional, or investment advisor. Advanta IRA as a company in general cannot provide any tax, legal, or financial advice. We're experts in the IRS rules and regulations regarding self-directed investing, but we always implore you to do your own due diligence and consult and construct your own team before you make any specific investments. So what is a self-directed IRA? It's basically a self-directed account, or an account in general, an IRA, that you can put into whatever assets you want, really, where you don't have a fiduciary or a financial advisor telling you what you should or should not invest into, or telling you what you are allowed or not allowed to invest into. A self-directed account is one where you can say pretty much anything under the sun I'd like to own with my retirement dollars, my tax sheltered retirement money, and you're allowed to do so. As long as you're following the IRS rules, which again, we're experts in, they're very simple rules to follow, and the options for your self-directed investing are very diverse. As long as it's not a life insurance policy or a hard to value collectible like antiques or fine wine or artwork, there's usually a way to structure the investment within the IRS rules and hold those assets in your account. Now, if you've never heard about self-direction, that's actually really common. Only about 4% of US-based retirement accounts are actively being self-directed. And in the grand scheme of things, that is an industry that hovers right around $40 trillion over the past few years. So of those $40 trillion, only about 1.5 trillion or so are being self-directed. And then again, of that, our clients under Advanta IRA's administration have just under 3 billion in the self-directed investing space. So it's really that education is not out there as thoroughly as it is for the wirehouse custodians or fiduciary companies, and they have a vested interest in having people think that self-direction is too risky or too volatile. Where really what you're doing when you self-direct is ideally less volatile because you're taking matters into your own hands with something you understand or you have interest in investing, instead of letting someone else say, hey, I have this certification of financial advisory capacity, and I'm going to take your money, I'm going to try to earn from it what I can, but I can't guarantee you anything, and you're going to pay me regardless of if I earn or lose on your money. So take it with what you will, but it's really a great tool for people that have their own interests and want to control their retirement dollars a little bit more thoroughly. And really, again, the biggest benefit of self-directed investing is that you can invest in what you know the best. We see a lot of real estate investments, to be honest. It's close to half of our client base for real estate asset classes, whether it's joining a limited partner syndication or owning a piece of rental property or fix and flip real estate. But our clients choose way more and way different opportunities as well because of what you're allowed to do with a self-directed account. So if you know how to earn money with any niche capacity, again, as I've said over the past few slides, it's likely you can use retirement dollars to do so. A few of the most unique investments we've ever seen, I actually covered a specific webinar on this topic about 2 weeks ago. People using their retirement accounts to invest into cryptocurrency, to be producers on movie projects, raw land and farm animals, sports teams. Just a few examples here to see how diverse these tools can actually help you become. Now, what is a fair market valuation? A fair market valuation, or FMV, is basically a required item for every asset in your retirement account on an annual basis. These valuations are supposed to be dated and turned in and as relevant as possible to the end of a calendar year. So we're looking for a fair market valuation, ideally dated December 31st, and to be turned in right around the end of December or early January. You may be allowed to create your own valuation, but it's always encouraged that you use a qualified third-party valuator. We'll get into where that makes more sense and where it makes sense to just value it yourself in a few slides. But basically, ideally, you're having someone look over the asset or verify if you have gone to an investment provider for like a limited partner syndication. If you're valuing a piece of property, that third party is usually the local jurisdiction that's done the tax filing records or the tax deed assessment. Again, I'll hyper focus on those when we get into the breaking down of specific asset classes. And just for everyone's context and understanding, this is not to punish you or change the way your account in the moment gets handled and assessed. The IRS typically uses these valuations just as a data point so that they can learn about investing trends, what years people may be investing heavier into certain asset classes, what asset classes are performing well versus not performing so well. And they use that to plan ahead and make suggestions for rules and regulation changes in the upcoming years. So it's not a specific item like in school that you're getting a grade for. It's just a data point. It's basically kind of akin to a census for the retirement account industry that the IRS takes annually. So some basic rules about fair market valuations. There, again, as I said, needs to be a separate valuation for each asset in your account. So it's usually not just where you're saying, oh, my whole account is valued at X dollar amount. You have to break it down. Asset 1 is valued at Y, asset 2 is valued at Z, and so on and so forth. We're trying, again, to get the valuation as close to December 31st as possible. Sometimes people provide it a bit earlier. Sometimes people provide it in the beginning of the following year. Depending on what you're doing with your account, you may be providing a valuation more frequently than once a year. So you may have a valuation update in March or April, and then another one in June or July if your asset value fluctuates. So at the root core, once a year, as close to the end of the year as possible. The value of your assets determined based on the fair market value at the time you're providing the value, not the cost you put into it when you purchase the asset. So just a quick example, if I bought a house 5 years ago for $100,000, well, this year, 5 years away from when I purchased it, the valuation is not simply $100,000. It's what the current value of that property is worth. An independent, neutral, qualified third party is encouraged to make these valuations. A person must not be considered a disqualified person to your retirement plan to be this qualified third party. Disqualified person, just for context, we usually go over that a little bit more thoroughly in the intro of these webinars. It's anyone on your lineal tree up and down. So your parents, your grandparents as far up as still alive, your children, your grandchildren as far young as you see, and yourself and your spouse, plus any business entities that they own. So if any of those people that I just mentioned own maybe a bookkeeping firm or a tax firm, you shouldn't have that firm be the third party valuator, or any of those individuals for that matter, be the third party valuator for your FMV. You're not required to pay for a valuation, but if it is necessary, any payment for the valuation does need to come out of your retirement account, not yourself personally. That comes into play specifically if you own real estate in your account and you are at required minimum distribution age, so you have to draw from the account. You at that point need to get a certified valuation of that property once every 3 calendar years. And if you're doing that, there's going to be a cost, and that cost needs to be paid by your retirement account, not out of pocket. Just a specific niche example. If you have more questions about paying for valuations, again, we can ask them in the question box, or we can cover them later. Just reach out to me one-to-one with an email or a phone call. So FMVs at their core must include certain information. Some of that information is any recharacterizations of money in the account, any conversions for the tax purposes from a tax deferred or traditional account to a Roth account, any rollovers out of an employer sponsored plan or a qualified plan to a IRA account, whether that's a rollover of tax deferred money to a tax deferred IRA or tax deferred money to a Roth IRA, meaning you're paying the taxes on the money at the time of that rollover conversion and letting it grow completely tax-free from that point moving on. FMVs also include contributions, and your required minimum distribution, if you're eligible, does need to be stated as well. And we specifically use Form 5498 to report the FMV to the IRS. A lot of these items are also inherently reported on Form 5498, so it just makes the most sense in that capacity. I see someone just posted they lost the audio. Can anyone else clarify if your audio is still working? It does not appear anything's changed on my end. So it may be just that individual. Still working is back. Okay, thank you. Thank you very much, everybody. Now that I'm actually looking at the questions box, before I move on to the next slide, let me go ahead and see if I can't answer a few of these that have come in. What about a condo purchase in 2023 and still undergoing renovations to then sell? Would purchase price plus products procured for the renovation be reasonable? Actually, the valuation on the property would not necessarily include those products procured for the renovation. It would be the root cost or value of the property at the time you're doing the value. So really, you go to the county record in theory and see what the county's assessed value is of the property, and that would be the valuation for this property. You'll get the benefit of the renovation when you go to sell the property later, or you've got the renovation completed and the valuation is higher at that point, whether it's through a certified valuation or the county's next assessment or whatever legal jurisdiction is doing that assessment, if it's a county or if it's any other municipality. Let's see, can you explain how this works with checkbook? I certainly will here shortly. What about FMV for private equity funds? I'm going to get into the FMV specific for each asset class, so I'm actually going to turn my attention back to my slide deck here, and I'm sure I'm going to cover a lot of these questions that I'm seeing in the questions box. So, asset types. We're breaking down a specific limited types of assets, and then I'm going to break down the proper valuation techniques and strategies for each of them. So just a list here of the various asset types. Pretty much anything you're going to invest into with your retirement account are going to be under any of these classifications. So a broker portfolio is basically if you're using your retirement account to go have traditional assets like stocks, bonds, mutual funds, commodities, forex, futures. That's just trading accounts. That's a simple asset class, and the valuation's pretty simple. You're just looking at the profile on that trading platform to see what your current value of all of those assets are. For real estate, this does include mortgage properties and land trusts. Those are a simple asset class as well, as I kind of described with answering a question earlier. It's basically the valuation provided by the county or a certified valuation if you're in need to get that for a few different purposes that may be applicable. Private equity, so private stocks, foreign stocks, investing into hedge funds, partnerships, LLCs. Limited partnership investing into syndication real estate falls under the private equity asset class. Pretty simple. Most of the time, you're just reaching out to the general partnership team or the issuer of the stock, the company you've invested into, the manager of the hedge fund, and asking them pretty much to provide the value for you. Liabilities like loans and mortgages payable by the account, these are negative value assets. The easiest way to typically value these are just to have an amortization chart or some sort of verifiable line item that says I've made X amount of payments. That means the current value of this loan is Y. It's pretty simple and straightforward. Notes receivable, same thing. If you've issued a note out with your retirement account, whether it's secured, unsecured, convertible, or a mortgage, you're just looking at the amortization chart to say how many times your borrower is paid on the loan versus the interest that it's incurring. And you'll set basically based off that chart what your current value is of the loan at the time you're valuing it. Qualified participant loans, they're specific loans you're allowed to take against a 401k plan. So if you have a solo 401k through Advanta, or if you're using another alternative retirement administrator, it's basically the same thing as I just covered for liabilities and notes receivable. The amortization chart or a simple review of how much you borrowed minus how much you paid back. Maybe include the interest depending on your tax perspective on that. Again, I'm not here to provide tax advice. I've seen people include the interest. I've seen people not include the interest and say, oh, that only gets calculated at the end of the loan period. I'm not here to say either way. I don't have that expertise. Other assets are just pretty much any other asset that doesn't fall into one of the categories that I've listed above. I'll cover briefly as well how you would value other assets. So we're going to pivot here a little bit. I'm going to break down and show you all a version of our fair market value form. I'm going to break down each type of asset I've just described and the proper details we're looking for valuing it. One quick thing, if you are an Advanta IRA client, we upload this fair market value form to your client portal for you to download and execute. When we upload it, you're receiving a copy that already has some of this information pre-populated for you. We also have a completely blank version that your client account manager could email you, but for ease and simplicity, we provide a valuation form pre-filled out with some of these details to each client for each asset they hold. We email our clients to let them know that this is in their online portal. And if we don't receive it by December 31st, as I've mentioned multiple times is the date we're looking for these, we typically send a few different follow-ups to let you know, hey, this is something we have to provide to the IRS, so we really need you to provide it to us so we can keep everything in appropriate order for your account. Again, we're here to administer and keep you all on the up and up with the IRS side of things. So it really helps when our clients are active and proactive in doing these fair market values. So with a brokerage account, we're looking just at the asset name, so the trading platform dash brokerage account, the asset type, brokerage portfolio, trading account, a few different ways you could word that, but pretty self-explanatory. CUSIP, that is something that we use internally to identify each client asset. It's called a CUSIP. That's the term we use. It's going to have a 2-letter code that breaks down the asset type. So in this case, BR for brokerage. And then it's going to have a different part, I believe it's 7 digits, that breaks down your specific asset. So these are going to be unique for each investment that anyone holds. When you're getting the form from our online login, we pre-populate that for you. So what you're going to be responsible for is pulling up your trading account, looking at the current value of it, and jotting that number down right here on the value of IRA ownership in this asset. The date of value, again, whatever date you're pulling that from your trading platform account. Attached supporting documentation is not always necessary, but if you can provide it, why not? It's very helpful. We stack it behind the fair market value in our records. So in this case, statement of accounts, a simple way to provide that. Just print off your screenshot from your trading platform or your monthly or quarterly statement that you receive. Now, scrolling down a little bit further, valuator's information. You can have your accountant value it. With a brokerage account or a trading account, the valuator is likely just going to be yourself logging into an online portal like you would your bank and seeing what the current balance is. So that's fine if that's the case. You leave section 3 blank and you just add your signature at the bottom, section 4 with the date. And that's exactly what you turn into us. That's all we're looking for. It does not need to be complicated. It does not need to take you an hour plus time. This really should only take Billy Brokerage 5 minutes to get all turned around for us. With real estate assets, again, this is a little bit more of a complex capacity, but we've got real estate asset. Obviously, the client's information for their account, their name, and their Advanta account number are going to be at the top. The asset description is going to be the actual property address, or if it were a plot of raw land, however it's listed on the deed of title is likely what we're looking for here. Asset type, real estate, raw land, anything just basically describing that it is a piece of real estate. And then the CUSIP, it's going to be RE or TR if it's a land trust, or LT if it's a land trust. And then 7 digits identifying that specific property. Now the value. With a piece of property, again, you can go to the county's appraised records. You can get a certified appraisal done if you may need it for other aspects of your investment strategy. That's one of the easiest way to do it. We cannot accept a certified market analysis or a Zillow report or something like that. This does have to be a little bit more thorough than those options. So if you have real estate, the easiest thing to do is just to go to the county's website or whatever your jurisdiction is and look up the last appraised value. It's very easy to identify that. Anyone can find it. You don't have to pay for it. And it's an easy way to get this turned in. In that case, for the evaluator information, you list the county appraiser's name. They're always on the header of the tax documents you receive in the mail. It'll be on the website that I'm describing for you to go to. You can check that box there for their qualification as real estate professional. Or again, if you had another professional do this for you, you would check the appropriate box. And we know that you're not going to get a signature from the appraiser. Those documents usually have their signature kind of inherently on it, but you can add the valuator information even if you know you're not collecting a signature from that valuator. And then your signature obviously needs to be on the document, and we turn that in. I've alluded to it a few times, but with real estate specifically, once you reach required minimum distribution age, you are required to get a certified appraisal every 3 years. I said there are some other reasons or rationale why you may get a certified appraisal. If you're doing a strategy where you're distributing your property in kind to yourself, you would have to get a certified appraisal done before you're allowed to initiate the distribution of whatever portion of the property that may be. So let's just say I own this $140,000 property in my retirement account, and I want to take 50% of it out of my retirement account to own personally, as I'm working on a strategy to ultimately take the whole property out and use it for personal purposes. I would have to get a certified appraisal done within 30 days of when I'm trying to initiate the distribution of that 50% and get the titling in the county records to say, oh, I took personally 50% of ownership of this property out of the retirement account. So that's a reason you would have a certified appraisal. And then ultimately that item can be good for your fair market value for a little bit longer than that county appraisal record would show. All right, private equity investment. So if you're investing into a limited partnership, a private stock, anything that is private equity, so the opposite of stocks, bonds, mutual funds, things on the public sector. The asset name is very simple. It's whatever you've invested into. That should be exactly what you see on your subscription documents. Very simple. Asset type, limited partnership, syndication. Doesn't have to be exact. It just needs to roughly describe it so that we know what is the asset you're talking about. And again, we're usually pre-populating these fields for you. The QSIP is going to list something to the effect of limited partnership and then an identifying 7 digits, LLC or LC, and then an identifying digits, PS for private stock, etc. Very simple, straightforward. Once you're a client of ours and you have a few assets, you'll start to get the hang of the capacity of how we name the QSIPs. Value of the ownership in this asset, in this case, was probably provided by an accountant or someone on the general partnership team of this limited partnership, or even the accountant of the partnership, but some third party has provided this valuation. The last known date of the valuation obviously needs to be there. These are important fields where attached supporting documentation doesn't need to be provided on every single fair market value. The specific dollar amount and the date of the valuation are always required. If we receive a FMV submission without these two fields, we really have to kick it back to the client and have them fill those in appropriately. In this case, again, a CPA did the valuation. Because it was a CPA and the client went straight to them, they're able to get a signature here and a date. The client signed and dated and submit that with the accountant's letter confirming the value. So a simple letter on letterhead saying, oh, the price per unit is, let's say, 5, and this client owns 3 units, 5,000 times 3, 15,000. That is the valuation for Returns Unlimited Limited Partnership. So liabilities, again, these are negative value assets. These are assets that your retirement account has borrowed, which we don't see a lot of, but I do want to make sure we express how to properly value them as well. So when you're valuing a liability asset, remember it's the outstanding value of the loan. Whether you want to include the interest that you owe on it as well, that's completely up to you and your tax advice or tax reference if you're using a tax advisor. But what we're looking at is the outstanding value of the loan, most easily determined by the loan documents, the actual loan agreement, and or the amortization table. The asset name is just going to be loan secured by or unsecured loan issued to the retirement account. Asset type, note payable, QSIP, LN for loan, and then the identifying unique figures there. In this case, a specific value provided at the end of November. Again, it doesn't have to hit right on the nose at the end of December, but that's as close as we're looking for. We start reaching out for fair market values typically at the beginning of November, end of September, to tell clients, I'm sorry, end of October, beginning of November, to tell clients, hey, this is on the horizon. We're really looking to get this process started. So we don't have too many clients pushing into April or March of the following year and still having not turned in their valuation for, in this case, 2023. This is an asset class where you may not need a valuator because you're just citing a specific loan document or an amortization chart. But if so, you have your attorney look things over. Maybe it was the attorney that drafted the loan documentations and prepared the amortization table. It could be a CPA. It could be a standard bookkeeper. We get their name. If they're available and have the opportunity to sign the document, that's great. If not, that's okay as well. Again, we're trying to collect as much viable information for reference and for documentation's sake. Then we need the client's name and signature as well. Notes receivable, so when your retirement account has loaned out money, it's basically the same as I just described with a little slight difference. This is a loan to and the name of the borrower, a note receivable within your retirement account, unsecured note, QSIP, secured note, QSIP, mortgage loan, QSIP. The dollar amount that the loan is currently having outstanding, whether you choose for that to include any outstanding interest to be earned as well on the investment. It's completely your discretion, completely your tax professional's discretion. The valuator, in this case, it's your own loan. It can be, as I mentioned on the last slide, a specific attorney or a CPA that maybe helped draft the loan agreement, or it can just be you, Larry Lender, citing your own amortization chart on file. If you are your own valuator, you really don't have to put your name there, as I said on one of the earlier examples, but you can. No signatures needed because we're having your signature down here in the actual account holder section anyway. Qualified participant loans, very similar. It's an outstanding loan that you've actually borrowed yourself against your 401k plan. These are always going to have the QSIP PL for participant loan. The value is going to be whatever's outstanding. You're citing the loan agreement specifically. If you have a qualified participant loan through us, we provide our clients the loan document and a quick chart to put together how much you're eligible to borrow against your 401k plan. And again, there's really no purpose to have a third-party evaluator for this type of asset. So you're going to usually cite yourself as the evaluator and execute this, sign it, send it back to us. We already also have this loan agreement on file, as with the other loans as well. So if you don't have your amortization chart, but you know one was drafted up and or your loan agreement, you can ask your account manager for copies of those documents to help you put those things together. I would be remiss if I didn't mention that. We have all the information from your assets on file. We'll be able to help you if you're just needing to reorganize, or maybe you upgraded your computer and you only had those documents on your old computer, something like that. We're here to help. So the final class here is other assets, kind of a catch-all for anything that I have not gone over specifically already. This example I'm just using for precious metals, but it could be any miscellaneous asset class that's not a piece of real estate or a paper asset like a loan or a private equity type asset. So precious metals. The asset name is going to be whatever the actual precious metal is. Gold American Eagle, silver bullion, whatever it may be. It could be Iraqi dinar, whatever the asset is. Name it to the best of your knowledge, to the best of your ability. The type, again, precious metals. It could be foreign currency, non-circulating currency. It could be cryptocurrency, anything really that you know we've used in the past to describe the asset type, or that again is already pre-filled in for you if you're pulling the page from our online login. The value of this type of asset, it usually can be verified from a precious metal dealer. Depending on, if it's cryptocurrency, it can be verified through different channels in the crypto space. It's going to be unique. It's going to be more unique than any of the asset classes I've talked about thus far, but that's up to you, again, as a self-directed client, to find where to appropriately determine the value or find the appropriate professional to evaluate this for you, whether that's a CPA, a manager of the entity that you invested with, or a specific professional like a real estate professional or an attorney that can provide their professional expertise, which they may charge you for, and that expense is due to be paid out of your retirement account, but nonetheless, it's a requirement, again, to turn this into the IRS annually. Provide a signature, date that as close to the date that you got that valuation. So in this case, you notice, got the valuation, thought about it for a day or two, maybe tried to find a valuator to certify and verify that value, and then just submit it 2 days later after doing a little bit of due diligence to make sure that was accurate to the best of Preston Mint's ability. That covers my generic examples. I'm going to turn my attention. I did see a lot of questions come in as I was going, so Let me backtrack for a second. I'll start reading some of your questions. This is kind of a point here as well. As I'm reading these, please feel free to add any additional questions you may have while I'm going through them. Before I go through them, I'm just going to let you know kind of a little bit of closing shop details. We do put on a lot of educational content. There's typically 2 of these educational webinars a week. We also have a blog with industry news with the retirement account investing industry. This is an election year, so again, a few of these previous year fair market valuations that the IRS have collected may lead them to suggest some legislation or some rule changes to the IRS rules for retirement account investing and self-directed investing. So if you're interested in that, to be on the cutting edge of what you may want to agree to or disagree to in upcoming legislation through this election cycle, please check out our blog. It's very easy to start an account. It takes you about 15 minutes to complete our application, get things turned around and ready to invest within about a week to a week and a half. Feel free to reach out to me if you want any more information, any specific educational content, a wealth of knowledge to that effect, and would be happy to point you in the direction of anything that can help you. And here's all my contact information. I'm going to go ahead and turn, like I just promised, to the questions here. Is a financial advisor who is paid a fee for managing an IRA considered a disqualified person for determining FMV? No, that financial advisor, as long as they're not a relative, a direct relative, a parent, a child, a business owner, or business owned by a parent or a child, or a spouse or yourself, that financial advisor would be fine to provide the valuation. And that is the case. That's why you maybe have not even heard about fair market values and you've had an account with Edward Jones, T. Rowe Price, Merrill Lynch for a number of years. They intuitively and inherently usually just do the FMV on your behalf as part of their fiduciary responsibilities. So again, in most cases, that is the case scenario, that financial advisor is just intuitively doing this as part of their role. With self-direction, that's not our role. Our role is to make sure you're following the IRS's rules for compliance sake, and in that case, providing the valuation of the self-directed assets that you've chosen to hold. Next question, do you need an FMV for the money not invested in the account? That is a great question. The answer is no. We can clearly identify and delineate what you have as liquid cash in your account. That's not technically an asset either. That's just undirected funds or uninvested funds. So that's not an asset. That is not something that needs to be valued as a FMV and turned in. Does each company our retirement vehicles are with produce this for us? I believe I vaguely answered that 2 questions ago. Each company may not produce this for you, but each company is required to submit this to the IRS. So, excuse me, if you have a managed account, they're likely doing this on your behalf and you may not even know about it. If you have a self-directed account, each self-directed administrator may approach this differently, but they're usually, as I said with Advanta, going to reach out to you a few months early and let you know that the fair market values due. They may, like us, provide you a template document that's mostly pre-filled for you, where you just have to add a dollar amount, a date, and a signature, plus maybe a signature of a valuator. It's case by case, but again, each asset that you have in your retirement account does need to have a fair market valuation turned into the IRS on an annual basis. Can you also explain how this works with checkbook? Yes, so checkbook falls under the private equity asset class. So an LLC or a checkbook IRA would be the asset class for the valuation. The proper and most efficient way to provide that valuation would be creating like an Excel spreadsheet or just a list and valuing each asset based on the parameters I've shown you and given you today, kind of as tools in your tool belt. Add each of those assets together plus the cash in that LLC's bank account And that bottom line is going to be the overall value you turn into your administrator for the checkbook LLC. So let me just kind of pull that information together in one simple example. I've got a property I own in the name of my LLC valued at $150,000. I've issued a note out that is a balloon note, so the borrower has not made any payments on it yet, for $50,000. I have $20 more thousand cash sitting in my checkbook IRA's bank account, so that's a $150,000 asset, a $50,000 asset, and $20,000 of cash. That all boils together for $220,000. That is what I would list on my fair market valuation for the LLC. And I provide that Excel spreadsheet or list, however it's drafted up, as the supporting documentation for that FMV. What about FMV for a private equity fund? I think some of these questions came in before I covered the actual examples of each asset class. Someone said they had to take a quick call. They could not did you say I cannot value my own plan if the value is based on financials provided by the organization managing the investment? Technically, in that case, you'd just be saying that that organization provided you the valuation, and you'd cite whether it be a specific individual and maybe ask if they can't get that person to sign the FMV form for you. A lot of these managing entities that you invest with are very familiar with this because each of their retirement account investors are coming to them at the same time of year. A lot of times with the larger firms we see, they reach out to us and reach out to the client account management team to help facilitate a smooth process for all the investors. So if we have a syndication group and there's 20 Advanta IRA clients all invested into that deal, sometimes for the ease of everyone involved, someone from the management team of that syndication will reach out and provide us a document on their letterhead that says every account holder has X amount of shares in this deal or units of ownership, and those units of ownership are valued at $1 per unit or $7.68 per unit. And that's going to be different most times than when you actually made that first investment transaction. So we help coordinate getting the client to approve that new letter as supporting document to a fair market valuation, and we update the value of your assets in your account based on that document. It's pretty easily to be coordinated, all being said. Do tax discounts factor into the FMV? The answer is no. If the private equity is created to invest in real estate, is my record type real estate or private equity? The record type will be private equity. The only time the record type is real estate is if there is a physical piece of real estate, a deed of title being held in the name of your retirement account. If you joined a private equity and the private equity specifically did a real estate investment, you're still invested into private equity. You're not owning a piece of the real estate itself. How can one evaluate a private equity fund? There is no real market value until the property is sold. Again, that's something where you're going to go to the management firm of the private equity. When you made the investment, whether it's $50,000, $100,000, that was an exchange for X amount of ownership in the deal. So your ownership is worth a set dollar amount, whether that fluctuates up or down. That's between yourself, the general partnership team, and or attorneys or CPAs to determine the value there. But it's not as difficult as one would think it may be for an asset like that. Did you say real estate syndications is considered private equity? Correct, yes. Can the RMD be calculated to include other IRA accounts? If the RMD is deducted from other accounts, do additional funds need to be deducted from an Advanta self-directed account? So each retirement account administrator that you have IRAs with are going to verify, report, and tell you what your RMD value is for that specific account. You can then take the RMD amount out of any of those accounts that you see fit. So let's just say I have an Advanta IRA account and I have an Edward Jones IRA account and I'm at RMD age. Well, My Advanta document says my RMD relative to that specific account is $3,000. And my Edward Jones document tells me my RMD specific to my Edward Jones account is $10,000. It does not matter if I take all $13,000 of my required minimum out of the Edward Jones account, out of the Advanta account. Maybe I split it 6.5 and 6.5. As long as you satisfy the total RMD total that all of your retirement accounts demand, that is fine. And we understand that's going to take place a lot because some people will have not so liquid investments in their self-directed account, whereas they can go to their managed account and liquidate some assets they have in the public sector, stocks, bonds, mutual funds, and draw from that to easily satisfy your RMD requirement. All right. Someone asked about valuing natural gas lease. That really depends on how the natural gas investment is structured. Typically, that's, in my experience, shares of ownership. And the share of ownership is going to have a dollar amount, whether that's set at $1 per unit, whether that's fluctuating in any other capacity. Usually you would go to the firm that you've made the natural gas investment with, and they help provide the appropriate valuation. A lot of my referral partners that are natural gas resources really help out to very easily just collect the FMV form, provide the value for that specific client and the specific assets in question, and even execute the valuator signature before sending it back to us or to the client directly. If asset is real estate, you only need to use the assessed value from the tax appraiser's website. You do not need to get a fair market valuation form from a realtor. You wouldn't get the fair market value form from the realtor, but you do need to fill out the fair market value form that we provide with the details from the appraiser's site. And if you can also take a screen grab of that or print it out and submit it to us as supporting documentation, that's what we're looking for. Usually when you reach out to a realtor, they're going to provide like a market analysis, a CMA or a certified market analysis, or an estimate based on other properties in the surrounding area. That is not an acceptable form of valuation for real estate. How does this apply to a specific firm's oil bonds? Again, that goes into the private equity asset class, private stock, private equity, and we usually reach out and work directly with that capital firm to facilitate a very easily submit valuation. Do we just report the total value of all stocks or each individual stock in the portfolio? That depends on how the asset is listed. Typically, it would just be the value of the entire portfolio if we're talking about a brokerage account. That would be the appropriate way to handle that. And I'm seeing just a few more, so I appreciate everyone for hanging along with me here. We have a checkbook control LLC. We have multiple assets, including silver, CDs, and cash. How many valuation forms do we need? Just one form. Your supporting documentation should list each of these various assets within the account, but you're just submitting one fair market value form for the LLC in itself, citing all of these specific assets within the LLC as to create a cumulative value. How do we value a loan if no payments have ever been made? Typically, the outstanding principal is going to be the value there. As I've said a few times throughout today's presentation, based on your expertise or the expertise of your tax/legal professional, you may also include the outstanding interest accumulated for that value as well. So if I loaned out $50,000 and my borrower still hasn't made a payment on it yet, let's just say I set it as a balloon note, you'll want to ideally follow an amortization chart. Now, whether that chart includes the 10% interest that the loan has over the 3 years and you're valuing it 1 year in, so 10% of $50,000, you want to add that amount to the valuation. That's completely up to you and or your appropriate professional that you're getting guidance from. Where on the website can the FMV form be found and downloaded? It should be in your online login as a client. If you're not sure how to get to your online login, please reach out to your client account manager. They'll be very happy to help you get to that package and to that page. All right, I've got one or two more here. If I have gold coins in my home wallet as part of this IRA, what happens if it gets lost or stolen? If I have gold coins in my home wallet, I'm assuming that means wallet, as part of this IRA, what happens if it gets lost or stolen? Um, you shouldn't have gold coins in your home. If you're if you're investing into precious metals with your retirement account, they do have to be stored in a depository box that you do not have personal direct access to. So I would implore that person to reach out to your client account manager or your IRA administrator and get that rectified immediately as possible, because you're not supposed to have direct access. If you have gold coins and you can go touch them and they're considered part of your retirement account, that should not be. You should fix that immediately. Another person asked about the uninvested amount in the account. I've already answered that. And it's looking like a few of these are repeating questions. So I think we're going to go ahead and wrap up. If there is anything that you still want to ask or have specific interest in, please feel free to reach out to me directly. I'll be very happy to get you in the direction of the appropriate answer and content, or make sure we loop in, if you're a client of ours, your client account manager that can provide you additional resources, whether it's helping you access the online login or helping you get your valuation turned in. Appreciate everyone for your time and participation today. I hope this has been helpful, and I hope that you have some smooth sailing and turning in your valuations for whatever assets you may hold, and happy investing. Thank you, everybody.